Hi people. In recent times, global central banks are using advanced monetary tools to stabilize market and encourage economic growth. RBI also uses methods like Operation Twist and liquidity management strategies to maintain financial stability. So today, let us understand these concepts in the simplest way possible. First, let us understand Operation Twist. Banks sometimes hesitate to lend to private companies because of bad loans or NPAs. To solve this issue, RBI encourages corporate borrowing. At the same time, banks and investors often prefer government securities or G6 over corporate bonds because government securities are less risky. So, under Operation Twist, RBI buys long term government securities and sells short term government securities in the market. When RBI buys long term G6, demand for these securities increases and long term interest rates decrease. As long-term government securities returns fall, investors start preferring long-term corporate bonds because they offer better yields or interest. This helps increase corporate borrowing and supports economic growth. Now let us move to the Market Stabilization Scheme or MSS. MSS was introduced in April 2004. It is a monetary policy intervention used by RBI to withdraw excess liquidity or money supply from the economy by selling government securities. These special government bonds are called market stabilization bonds. Under the system, the government lends bonds or securities to RBI. One important point is that open market operations can either increase or decrease liquidity, but MSS is used only to reduce liquidity. Finally, let us understand quantitative easing or QE. Quantitative easing is an unconventional monetary policy used by central banks when standard money policy becomes ineffective. This situation usually happens when short-term interest rate becomes zero or close to zero. At that point, normal open market operations stop working effectively. So instead, the central bank purchases large amount of assets using newly created bank reserves. This increases money supply and provides banks with more liquidity. In simple terms, we say quantitative easing means printing or creating more money digitally to support the economy during difficult situations. So overall, Operation Twist changes long-term interest rate, MSS removes extra liquidity, and quantitative easing injects massive liquidity into the economy.